Welcome to this video. So I'm just sat here in this absolutely beautiful cafe in Medina, Saudi Arabia, and I wanted to talk about 5 tax cases that we currently have ongoing at ASWATAX. Some of them would be live clients, some of them would be at the proposal stage, but most likely progress to formal engagement. As a firm, we deal with many different matters, we deal with different clients, different industries. So let's get straight into it. So the first case that we have on is a client based in London, husband and wife, and her father is based in Iraq, and he owns a valuable property in London, and the plan was for him to pass the asset on to his daughter and her husband. And what's happened is that if he gifts the property to his daughter, there will be large amounts of capital gains tax to pay in excess of £70,000. So what we've come out with is we provide options. We don't ever tell clients do this, do that. It's not, that's not part of our work. It's about us assessing the client's situation and then presenting the relevant options. So one of the options that we presented, and it's effectively worked out quite well, I had a call with the client last night, is for the father to transfer the asset into a discretionary trust for the benefit of his grandchildren. Benefits are many. Benefit of his grandchildren, benefits are many. You know what I'm trying to say. The benefits, there's always pros and cons when it comes to tax planning, but the benefits here are no capital gains tax will be payable now. Yes, it's a deferral relief, so therefore at some point there will be capital gains tax payable, but currently, and the discretionary trust is usually something to look at long term, so no capital gains tax to pay, and he's achieving his objective. Number 2 is that the kids have their personal allowances. So kids are 19, 18 and 12. 19, 18 and 9. So all the kids have their personal allowances, therefore no tax to pay on the rental income. I was explaining to the client how trust taxation works. So broadly speaking, trusts pay tax at the highest rate, which is 45% for income, and for dividends 39.1%. But then you have the whole thing whereby when it flows through to the beneficiaries, that's when you have the offset in calculation. So that's the first client. I don't want to go into too much detail, of course. The second client is, which one should I touch upon now? Okay, we have a client, a group of companies, but they were all standalone. So they've been trading for about 10, 15 years now, since the incorporation of the first business. It's an educational, they provide educational services, and they had many standalone companies. I think they have 5 now in total standalone. Yeah, 5. So we were introduced to implement a group structure. We now have a holding company on top, and we have the 4 subsidiaries. We have 3 subsidiaries. One we're keeping out for the time being because there's an external shareholder there, and that business is still standalone for the time being, but we'll assess how we can come into the group. With that type of work, you have to have HMRC clearance, you have to assess the tax implications, capital gains tax, stamp duty on shares, and then also keeping in mind the shareholders' future plans, which is potential exit within the next 5 years. The third case that I can touch upon is we have a family. So we have husband, wife, son, daughter. There is another son, but he's not involved in the property business. Parents, mother and father, they own many properties. So again, top of my head, about 14 properties in their personal capacities. They own about 4 properties in a partnership, and 2 properties and 2 pieces of land in a company, but the company is the father, son and daughter as shareholders. We've been introduced, we've been brought in as the experts, as the specialists. Property tax, international tax, inheritance tax, these are all matters we're looking at every single day. How can we get everything together? Father's now thinking about inheritance tax. I think the main home is around 1 million, the mother and father, so they've effectively used up their IHT allowances, the nil rate band 325,000 each and 175,000 each for the residence nil rate band. If it's available, it should be available. So what do we do now? We have an estate, a balancing value of estate of about 3.7 million. I haven't opened this case up since last week, so I'm just a bit thinking. We have so many different cases, different valuations, different figures. 3.7 million in excess. If there's no planning undertaken, we're looking at easily over £1 million inheritance tax bill. Definitely over £1 million. So we've been brought in to assess how we can, mitigate the inheritance tax position, structure things correctly for now and going forward, because it is a bit of a mess. You have too many different entities, and bringing in the son and daughter tax efficiently. That's something we can do for you. That's something we're looking at for this family. I won't talk too much about what the steps actually are, but on a very high level, we will be looking at incorporating the property portfolio. We would be looking at growth and freezer shares as a mechanism to bring in the son and daughter. That's another case, because we'll be incorporating into the existing limited company. Son and daughter are already shareholders, but we need to assess because there's a part disposal, right? So that's a case where we've just brought the client on last week. So that's something we need to look at in more detail. But it's something we'll end up coming to a good solution for the client. The fourth case to discuss is around a large R&D claim that I just submitted. Myself and my colleague just submitted yesterday. It's a design and engineering firm based in the northeast of the UK. 5 different projects we claimed for. Additional information form has gone to HMRC now. It's the CT 600 that needs to be looked at. It was a longer period, so it was more than 12 months, so that it was a bit fiddly in terms of how the reporting to HMRC is undertaken. We also have, so we're looking at 86% in terms of the R&D uplift, and the tax benefit, I think, is easily in the region of £150,000, the tax saving. The actual claim is in the region of about 700,000, I think, if I'm not mistaken. So that's case number 4. Case number 5, which one shall I end with? Okay, let me end with this case. I'll make a separate video for this one particular case as a case study. So I'll talk about another case, which is, it was very nice to receive a call a couple of weeks ago from a single mother of 4 based in London. She has a property portfolio of about 6 properties, and the reason she reached out is because she says she's been looking for expert tax advisor for a while, and she said when she came across my videos, she thought that I came across very friendly and that she can relate to me, and she felt comfortable working with me, which is always great to hear. So she's come on board now. 6 properties. Again, what should we do? She's got 4 children. She wants to look after all her children. How do we sort of manage things? She's just come on board recently. Again, it's not something we've looked at in detail, but that is a client case that we are currently working on, myself and my colleagues. Please reach out if you'd like a chat. We are chartered tax advisors, very, very well versed. There's many clients that I haven't mentioned. I'm talking about ultra high net worth clients. Maybe I'll make a video just talking about 3, for example, ultra high net worth clients. For example, one of my clients is I'll be going to the races in Windsor in July for the horse racing. But I hope you enjoyed the video. Don't forget to like, comment, share and subscribe, and we shall speak to you soon. My email address is down below. Thank you. Bye.